anybody can get a high return out of high risk. You can say, Jim, I'm going to management money. I go to a casino, bet it all on red. If I win, I come back and say, hey, Shane, look how much I made. And of course, if it becomes a black, you lose everything. So that's a high risk, high reward, and in the long run, no winning proposition. But the question is, can you increase the return without increasing risk, or can you increase the return more than the amount of risk? That's what diversification does. The other thing that cash does is the exact opposite of leverage. A lot of the assets I mentioned, include stocks, bonds, and hedge funds, and others, and gold for that matter, they're volatile. There's some volatility. Cash has zero volatility. It's just cash. Cash gives you optionality. It has embedded optionality. So we live in an uncertain world. That's kind of obvious. But how deep is the uncertainty? How long will the uncertainty go on? We don't really know. But so what that means is if you place your bets, you say, okay, I really want to get into bonds. I think there's a place for bonds. You get into bonds, and all of a sudden here comes the inflation. Those bonds are going to do very poorly. The cash is in the middle. Cash is the thing that connects the two. And cash has a couple of interesting properties. But people say, why would you have cash? It has no yield. Well, it has a very low yield. There's no question of that. But in a deflationary environment, deflation, cash can be your best performing asset because the nominal value is pretty much unchanged, but the real value goes up because every dollar is worth more in a deflationary world. Most people don't really understand diversification. I run into people all the time that go, I'm highly diversified. I've got 50 different stocks in 10 different sectors, technology, consumer non-durables, services, mining, etc. I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they become highly correlated in certain conditions. So yeah, you may have a lot of different stocks, fine. But if the stock market's going down, they all tend to go down together. If it's going up, they all tend to go up together. You're not really diversified if you're in a single asset class.
Fiscal policy has no cumulative impact. People say, well, how can that be? You had a $1 trillion baseline budget deficits in fiscal 2020, fiscal 2021. Donald Trump put on $3 trillion of additional deficit spending on top of that. President Biden so far has put on $2 trillion of additional spending. So that's 5 plus 2, so that's $7 trillion of deficit. And the Biden administration is planning $4 trillion more later this year, which they're going to get probably before September.
Anybody can get a high return out of high risk. You can say, Jim, I'm going to management money. I go to a casino, bet it all on red. If I win, I come back and say, hey, Shane, look how much I made. But of course, if it becomes a black, you lose everything. So that's a high risk, high reward, and in the long run, not winning proposition. But the question is, can you increase the return without increasing risk, or can you increase the return more than the amount of risk? That's what diversification does.
So that's $9 trillion of deficit spending. When going into this, the national debt after 230 years was only $22 trillion. So you just put $9 trillion of deficit on top of $22 trillion. It took, again, 230 years to get to 22, but we got to 31 real fast, just in 2 years. Well, doesn't that mean the economy is booming? Again, the answer is no. And the reason in the United States, this is not true in Australia, by the way, but it is true in the United States.
Real diversification means having numerous asset classes that are not highly correlated to each other. So have a slice of stocks, absolutely, by all means. Have some government bonds, for the American investor, a lot of global investors, in fact, 10-year treasury notes. But Australian government bonds for the Australian investor, etc. Have some land, have some real estate, have some venture, have some so-called alternative assets, hedge funds. If you can get in, they can be hard to get into, etc. Venture and natural resources, oil, energy, water, and then some gold and some silver. So that's real diversification because gold will not correlate to stocks. Sometimes it does, but often they move in opposite directions. Gold doesn't. Gold correlates to bonds a little bit, but then you've got to throw in inflation, which helps gold and does not help bonds.
It's going up. It's going up a lot. And let me just back that up a little bit, because that's easy to say. I don't say things like that without a lot of analysis. There are three different ways to think about it. One is just some technical analysis. This is the third great bull market in gold in history. And when I say history, I'm only going back to 1971, because prior to 1971, gold was money. So you didn't have a bull market or a bear market. It was fixed to the dollar. The people who bang the table and say, give me a gold standard, I'm like, well, be careful what you wish for, because in a gold standard, you're not going to make any money on gold because it's fixed, it's pegged to the dollar. If you want to make money on gold, you would actually be against a gold standard, because they keep screwing up the currency and the gold goes up.
The other thing that cash does is the exact opposite of leverage. A lot of the assets I mentioned, that include stocks, bonds, and hedge funds and others, and gold for that matter, they're volatile. They have some volatility. Cash has zero volatility. It's just cash. And so what it does is it reduces the volatility of an overall portfolio. So you can have volatile assets on the other end of the barbell, but cash kind of damps that down a little bit. It helps you sleep at night. And then the third thing it does, and this is not very well appreciated, cash gives you optionality. It has embedded optionality. So we live in an uncertain world. That's kind of obvious. But how deep is the uncertainty? How long will the uncertainty go on? We don't really know. But so what that means is if you place your bets, you say, okay, I really want to get into bonds. I think there's a place for bonds. You get into bonds, and all of a sudden here comes the inflation. Those bonds are going to do very poorly. If you get into stocks and here comes a recession, the stocks are going to do poorly. So these bets can be good bets, but it can also be a mistake. Or you get into a private equity fund, can do very well, some have, but it's completely illiquid.
The Federal Reserve has printed over $4 trillion of base money, and that's M0, so-called, and our M1 numbers are going up even more. People go, well, look at all those trillions of dollars the Fed is printing. We're going to get inflation. No, we're not anytime soon. Money printing does not cause inflation. The Austrian school says it does. A lot of the libertarians say it does. It doesn't. We had money printing with QE 1, 2, 3, and 4 from 2009 to 2019. We never got serious inflation, and we're not getting it now.
A significant slug in cash, maybe as much as 30%. And I actually call it the barbell portfolio. So, barbell, you have two heavy ends and a connector, so over here are your deflation hedges, and your deflation hedges would be, bonds, utilities, and then you have your inflation hedges, and they might be, a normal stock portfolio, gold, etc. But cash is in the middle. Cash is the thing that connects the two, and cash has a couple of interesting properties. People say, why would you have cash? It has no yield. Well, it has a very low yield. There's no question about that. But in a deflationary environment, deflation, cash can be your best performing asset, because the nominal value is pretty much unchanged, but the real value goes up because every dollar is worth more in a deflationary world. The question is, can you increase the return without increasing risk, or can you increase the return more than the amount of risk? That's what diversification does.
So that's that's $9 trillion of deficit spending. When going into this, the national debt after 230 years was only $22 trillion.
Cash gives you optionality. It has embedded optionality. So we live in an uncertain world. That's kind of obvious. But how deep is the uncertainty? How long will the uncertainty go on?